earnings on HDFC Bank and the Nifty Bank. Let's see whether people are checking into the hospitality sector or not. As summer approaches, hotel bookings are set to rise owing to a surge in travel. We are now tracking the travel trends across the sector along with the outlook for the year as well. We have Nikhil Sharma, who's the MD and COO-South Asia at Radisson Hotel Group. We also have Arjun Baljee, who is the president at Royal Orchid, joining in. Thanks a lot, Nikhil and Arjun, for joining in. Let's come across to you, Nikhil, first. You know, over the last couple of days, there were a lot of summits that were taking place in the hospitality sector. Just wanted to understand what have been the key takeaways in terms of trends for the fourth quarter for the industry and the outlook for this year. I mean, are, RevPARs too high after the growth that we've seen, or do you believe there is room for more growth there?
Firstly, Mangalam, thank you for having me. I would just say, despite the global headwinds, supply chain disruptions that we're seeing, capital markets being very cautious, India's domestic travel market remains resilient. The GDP growth is a factor in that. Of course, we're seeing 9% personal consumption go up. At Radisson, we've seen in FY25 RevPAR growth by 13%, and we have a very, very strong pipeline for FY26 at the moment.
All right. And Arjun, your thoughts on the industry right now? I mean, how are you looking at openings in the next year, occupancies? How are they likely to rise up? And, I'm looking at your average room rate. It's close to around 5,500 rupees odd. What is your prognosis on, moving away from the positioning that you're at, get a higher ARR for your products?
Well, thanks for having me. I think at Royal Orchid, our mix of about 120 odd hotels predominantly sit in the tier 2 and below cities. And in those cities, of course, we focus on the smaller hotels that fortunately people like Nikhil don't like. So, when we're targeting in India for India strategy, you've got the smaller 60 to 100 key properties where ARRs tend to be a little lower. But also, just taking a step back, a vast amount of our growth has come in the last 2 years. And hotels typically take 1,000 days to settle in. So we're in the upswing period. Now, just from the last quarter, or say, if you look at the Q-on-Q growth, we've grown 27% in revenue, right, quarter on quarter. We've seen a PAT growth of 140%. So it's incremental. It is a cautiously optimistic approach towards growing the business. And we do see ARRs inching upwards. You will see that in our numbers with, the Mumbai hotel opening and some of the key tier 1 larger hotels that we're opening in the near future. We have a number of hotels in the upscale leisure segment that are coming on stream. So they will obviously add to the upswing in the quarters to come.
Okay. All right. Nikhil, let me come back to you. At what rate is it enough? I was on a staycation in this weekend itself. And on Saturday, when I was checking in and asked them, what is the occupancy today? They said it's around 95%. I said, okay, it's a Sunday tomorrow. Maybe it'll be less. They said, no, tomorrow's 98%. Wow, this is, a chain in Powai itself. So that's showing the kind of interest levels. People are totally booked out. But how much of upside is to go on the ARR, Nikhil? At some point of time, it's going to get too expensive.
Well, Nigel, if you look at the branded hotel supply in the country, right, it's growing at 4.2% CAGR, right? And the demand is really outpacing it. It's at 8 to 9% CAGR. So there is a widening gap, and that supports the ADR growth. And in my personal view, in this financial year, you should see a further rise of about 7.5 to 8.5% in the ADRs in key markets, and of course, leisure destinations and micro markets like the one you were in Powai on the weekend.
All right. I have to ask these questions to both of you all, and we'll start with, Royal Orchid first and then come back to Nikhil. There is a slew of signings lined up for all of you all. Is scaling up a problem given the limited supply and given the number of people who are aiming for properties? Because everyone we speak to, they say that, okay, demand is growing in double digits. Supply is likely to grow at best at, mid to high single digits. More importantly, everyone is chasing the same assets. So does that make it a lot more difficult for you to scale? And not only was it, difficult already with the larger players coming in, we had Interglobe and Accor renewed their promise to become fast. They have a target of almost, 300 hotels by 2030 from 60, 70 that they have right now. Arjun?
Well, I don't see that being a problem at all. I think India is a large enough market for all of us to grow and for all of us to add hotel supply. There is enough new builds happening right across the country. That is something that I think Nikhil will agree with. That there's enough room for Radisson and Royal Orchid to grow in the same markets because the hotels are coming up. The other thing is the conversions. So switching from unbranded to branded is something that we've seen over the last 5 years, and that is accelerating. So I do not see competition between brands being a reason for degrowth at all, or rather slowing down.
And Nikhil, your thoughts?
Well, Mangalam, India has about 185,000 branded rooms at the moment, and Arjun spends a lot of time in Dubai, so I'll take Dubai as an example. Dubai as a city has about close to 150, 160,000 branded rooms, right? So it just gives you the length and breadth of this country where we need branded supply, and one of the things that Arjun alluded to was conversions and getting more unbranded hotels into branded space, and you will see that growth. In the last 14 months, we've actually signed hotels in 45 new cities. We are in 75 cities at the moment, with almost 130 operating hotels. We go to 114 cities in the country. So the real growth actually lies outside the top 10 key metros, if you may call them, or key cities. The real growth lies in Bharat, and that's where we are seeing 60% of our future pipeline, whether it's tier 2, tier 3, or new leisure destinations that we are creating, like Saputara, Karjat, and so on and so forth. So really the flag planters in making sure that tourism reaches the rest of the country. Of course, spiritual travel continues to grow, whether it is Ayodhya, Prayagraj, or Amritsar, and you will see more and more of spiritual travel.
We take that point. We are looking at JLL's recent report as well. Tier 2 and Tier 3 cities accounted for nearly 50% plus transactions in 2024. That's likely to grow here as well. We'll leave you both with just one number each. Next year, what level do you expect your occupancies to be at? How much higher would your RevPARs be on account of that? And if you would give us a sense of how many hotels are both of you all looking to open in the next year. Start with Nikhil.
Well, we intend to open 20 hotels this calendar year. So by next April, we should be operating 150 hotels in India itself. Like I said, ADR growth anywhere between 7.5% to 8.5%. I see MICE growth, and we didn't come to that point, but MICE is back. Of course, weddings have been back, corporate offsites are back, and we've seen just that segment growing by 18% over last year. So that's going to lead to another strong growth. Again, in hotels that have convention centers and so on and so forth. So Mangalam, to your point, 60% focus on tier 2, tier 3 cities from an openings perspective, and an ADR growth of anywhere between 8.5% to 9.5%.
All right. Arjun, you said that Nikhil wasn't interested in the markets that you were operating in now, but now he's saying that 60% growth comes in.
Smaller size hotels that we are after, buddy.
Okay, but tell us, what are you planning for now in light of what's taking place in tier 2 and tier 3 cities? Next year, what's your target?
We have 28 hotels that we've announced that are opening in the next calendar year. We're signing hotels regularly. So I think from a listed company perspective, what I can tell you is that we've got 28 hotels that are confirmed opening, should take us to about 140 operating assets. As I said, the focus of the company last year and a half has been return on capital and return on equity. And I think we're in the top of the industry, of the listed players, at least on those two metrics. And having looked at those two metrics, we're doing flexi leases, we're doing management contracts, and now, of course, a big franchise push. We've had a 6% quarter-on-quarter RevPAR growth, and we certainly hope to see that increase as times come.
Is that tier 2 and tier 3 will lead growth, so the industry is poised for 6 to 8% between the two of you all, at least, RevPAR growth, with a higher share of revenue coming in from weddings, marriages, management, corporate events, etc., and all those offsites. Nigel.
Just thank you, gentlemen, for joining in, and wishing you all the best. And we look forward to chatting up with you all as the year progresses. Clearly, you're sounding very, very optimistic on business prospects going ahead.
Thanks for having us.
Mangalam, you're checking this weekend?
No, I'm not checking it this weekend, but my worry is the more optimistic they sound, the more pessimistic I become, because I have to spend so much more if at all we have to go there.
The only trick, Mangalam, is to book well in advance. You get some deals, try to squeeze it in there, and now since you're a father, it'll get even more interesting.
Let's see how that goes.
Okay, all right. I think, we